welcome back to our podcast. I'm Dan Clark. I'm with Juan Escano, and we have a special guest today. And we're really excited to have Kevin Messiah with us today. Kevin, I'm going to let you kind of introduce yourself because it's a little complicated and I can't remember all the wonderful things you do. So please take a few moments, let us know who you are and what you are doing.
Thanks, Dan, and thanks for having me on the podcast. So again, my name is Kevin Messiah. I work at the Federal Reserve Bank of Atlanta, and I've been in bank supervision for about 14 years now. Actually, I spent 7 years at the FDIC, working through, let's call it, the Great Recession, and dealing with the credit crisis that presented itself at that time. Largely working in community banks, regional banks, but also spent a lot of time working at the FDIC's largest institution at that time that we supervised. So I spent 7 years there, and then I decided to continue to work in supervision, but take another opportunity with the Federal Reserve Bank. So I've been with the Federal Reserve Bank now for also 7 years. Worked in a variety of areas, including community bank supervision. I was the assistant CPC for one of our larger regional banks. And now, most recently, I serve as the director over our cybersecurity, operational resilience, and emerging technology team, and also been involved in broader system fintech supervisory efforts. So, been in supervision for a long time. Enjoy it, and it's been interesting to see the industry evolve since I started 14 years ago. And I just want to make a few disclosures before we continue on the podcast. So I do work for the Federal Reserve Bank of Atlanta now, but I just want to make a few disclosures that we have. The opinions expressed in today's discussion are intended for informational purposes and are not the opinions of nor binding on the Federal Reserve Bank of Atlanta or the Federal Reserve Board of Governors. Also, want to make a note that my participation in this podcast should not be interpreted as promoting or endorsing any products or services developed or made available through ZHorse. So, with that out of the way, certainly look forward to the discussions today, Dan.
Thanks very much, Kevin. And we understand all those disclaimers and we will abide by those ourselves as well. As you may know, I've worked in financial services for a long time, so I'm very familiar with the FDIC and the FRB. I had some friends that actually worked in both areas, and I've had some regulators that weren't quite as friendly as I was, uh, which happens observations with us from a perspective that is more national in context. And hopefully our questions will be those that are beneficial to our audience and some that will actually be fun for you to talk about as well. Uh, I thought we would start with the first one, and one of the things that we find a lot is when we're talking to people is about a risk culture in an organization. We say, well, financial institution has a great risk culture. That one's not so hot. I worked in a good one. I worked in an average one, et cetera, et cetera. From your observations and your traveling around, is there any characteristics that you could kind of pinpoint that might be characteristic of a good risk culture in an organization?
Yeah, I think there's many aspects that we see that are good. And I think the first thing is to take a step back and, when we talk about culture, like really like what are we talking about, right? Um, and it really, the culture boils down to a set of corporate norms and attitudes, right, related to risk awareness, risk taking, risk management. At the end of the day, I think we as supervisors realize that banks are in the business of taking risk, right? They take risk to generate returns, and our view is not to ensure that all those risks are eliminated, right? We need to make sure that banks are aware of the risks they're taking and that they're appropriately identifying, monitoring, and managing those risks, right? And so that's our focus, and that should be what the focus of the organization is. So when we're thinking about culture, the biggest aspect is that tone from the top, right? So it starts with the board of directors in terms of, hey, at the end of the day, the board of directors, they're overseeing management, and what tone are they setting for the organization? That could be within their policies, within their risk appetite, and that really should really be pushed down to management, and there really needs to be total alignment of that across the organization, right? You get into situations where there's a misalignment between that culture that the board is setting and senior management and kind of the boots on the ground first line business developers. You're going to run
Hmm.
into issues, right, where there's
Yep.
not buy-in across the organization. So it's setting those policies that folks are buying into. Another big thing that has even come up recently is making sure that at the end of the day, a lot of people, they're working for compensation, right? So
Yep.
making sure that you're rewarding people and that incentive comp is aligned with that risk culture and is promoting that prudent level of risk taking and alignment with the expectations that the board and management has set out.
Interesting. Interesting. Let's switch it just a little bit. Same topic. Just look at it from the other side. Have you ever seen anything, Kevin, where there any culture that looks really, really good, but is kind of fake? And the only reason I ask that question is that we continue to have some corporate meltdowns that are generated by poor risk management behavior. And I get the feeling that maybe sometimes we put on a good show, but we may not have the meat there. Are there any warning signs that we might be looking for as we are within our organizations trying to strengthen risk management that might be kind of out there saying, you better look at this a little deeper. It's not really what it looks like it is.
Yeah, for sure. I mean, I think at the end of the day, let's say the board is establishing policies, and I think it's up for us and the board to make sure that those policies and those risk limits are tailored appropriately for the financial institution, their financial capacity, and then if we can look at the board and say, okay, they're setting the tone from the top, they've got the appropriate limits, they've got the appropriate policies, they're setting the appropriate level of guidance for management to follow, and then management starts to begin to deviate from that, right? So you come in and you say, well, look, they have an appropriate risk appetite, there's a culture here, but then you start to see deviations from that, and it could be a case of trying to recalibrate limits, or base
Mm.
changing assumptions in certain risk management and monitoring items, or going to the board for frequent amendments to policies to amend the risk appetite, or certain things like that. So it's one thing for the board to set out the direction for the bank, but then the other part of it is if you are starting to see frequent changes to those items, then I think you have to call into question into terms of, well, what is the real culture of the organization, what is the culture of the risk taking and the risk appetite, if management is consistently coming back to change limits, change concentration thresholds, and change the level of risk that they are really willing to take. So I think it's that thing that not to say that policies shouldn't be amended or tailored for situations
Mhm.
or how the institution is changing, but those changes should really come down to the board with feedback from management, and they really shouldn't be subject to frequent revisions, and even measurement tools shouldn't be subject to frequent assumption changes and things like that.
Excellent, excellent. Some good insights there. I appreciate that a lot. You've mentioned the board a couple times, so I've got a question on the board if you don't mind. One of the things that we hear, Kevin, is, and this comes mostly from chief audit executives, but also a few risk managers, and it talks about messaging to the board. They are frustrated because they seem to not be effective in letting the board know what is important from a risk perspective, and they tend to get distracted in the board meetings or in the audit committee meetings by senior management kind of running with the message and changing the tone of the message. Is there anything, since you deal with a lot of boards and you deal with a lot of those senior executives, are there any suggestions or observations you might have that could help people like a chief audit executive or risk manager who needs to message to the board and they have limited time to actually talk to them? What might be some things they could consider to be more effective in their communication with the board to support that tone at the top that you've mentioned?
Yeah, no doubt about it. I guess the first thing I'll note is that we're humans, right? We're all
Yeah.
different. So we all respond differently to different things, right? And every board at every organization is going to be different. They have people of different backgrounds, different skills, people that come from different industries, financial experts, could be risk experts, could be IT experts. So, ideally, we would hope that our organizations have a board that's constructed of sort of a well-rounded board that could provide a more holistic view in terms of guiding that financial institution. But so I think some of my comments would be on some items that we've seen work, but I think there's no one approach that is like this is the golden ticket. I think when you're a risk manager or you're an audit and you're going to the board, you really need to um, have an understanding of who your board is, what they like to see, and what they're going to respond to. Because what may work for one board may not work for another, right? But I think when we're thinking about sort of what works, a big thing we're focused on is forward-looking supervision, right? And not being reactive to sort of past events. And if we wait for evidence of what's going to cause financial harm or significant issues to that particular institution, it's going to be too late, right?
Yeah.
So when if you're a risk manager, you got to constantly be looking at the specific balance sheet of your financial institution, the composition of the assets, liabilities, and to figure out really where the risk lies for that specific institution. And then thinking about that, what I found really gathers a good response from the board is thinking about scenario analyses
Mhm.
of depending on the construct of your balance sheet, specific scenarios, and how those items, because when you think about the probability of events and the impact of events, it's very hard to, especially for smaller community banks that they don't have the complexity and the tools, the statisticians and the quants experts to develop these things. A simple scenario analysis, stress testing analysis where you look across a variety of scenarios with assumptions tailored for how the bank or customers may react in a certain scenario, and then
Mhm.
present those, and then you can quantify those risks, and then present those. So at the end of the day, most banks are managing their bank for, I think, what they view the economy to be, or what they view the outlook to be. But
Yep.
risk managers are really focused on more of those tail events, right? To make sure that the financial institution is set up in a resilient way where they can respond to any of those issues that may arise. And one of the best ways to think about that is through scenario analysis, where you're able to stress test assumptions, to understand, get a better idea of how the balance sheet may behave, how customers may behave. And we've seen that recently, right? Who would have thought that? Yeah, I know it's not in the community bank space, but who would have thought that you could see the deposit outflows that we've seen in the
Yeah.
recent banking failures, right? No one could have predicted to that, right? And not to say that banks need to be managing to that, but certainly they need to think through potential scenarios depending on any sort of concentrations they have, depending on the type of customers they have, depending on the asset classes they have. Their maybe their CRE exposures or other type of credit exposures. So there's a wide variety of things to think through, and I think that's one of the better ways, thinking through those scenario analysis and being able to quantify that.
Yep. You mentioned something, and I'm going to go off script here for a
Mhm.
second. I thought it was really interesting. One of the articles I read was about the impact on the deposit ex the exodus of deposits from banking because of Silicon Valley and all of that good little scenario. I thought it was interesting that somebody opined on the impact of social media on the acceleration of that. Is social media something that's emerging that we should be really cognizant of? Or is that kind of like we should have been known about it before?
No, I
Or
think
can you
yeah, I
or
mean,
can
I
you
think
comment on that?
yeah, I mean, for a long time we've talked about reputational risk, right?
Yeah.
It's been talked about for years, right? But how reputational risk to financial institutions presented itself is evolving, is changing, right? So In the past, it was traditional media. Well, you talk about paper newspaper, then it was online media. Now it's unfortunately now it's social media and and I would say across the industry, especially at larger institutions, they do have they are monitoring social media sentiment, right?
Hmm.
They're monitoring the amount of tweets or the amount of interactions related to where their institutions are referenced, and get a better understanding of what that sentiment is and what that reaction is, right? So social media certainly has the potential to accelerate the impact on an institution, just given its reach and the speed that a message can reach just millions of people, right? And then but the situations are all unique, right? Some of these situations were impacted by well-connected customers across a specific industry that
Yep.
really precipitated that sort of response. So not to say that it would happen in all the scenarios, but I think the overall landscape is changing. And when we think about reputational risk, social media is going to be a big part of that in terms of how fast messages can be spread and the impact it can have.
Excellent, excellent. Yeah, I found that really it wasn't surprising. I think the scope was surprising and how quickly influencers or opinions are made that way. Let's get back to talking about risk management in general. And the next question that I'd like you to maybe get share a little insight on is the concept of enterprise risk management. We talk about it a lot, and we see the management of risk takes a lot of different forms, and there's different methodologies that people use. And I know that all methodologies are different, and some are stronger in some areas than others, but it's up to the institution to pick those. And this may sound like a dumb question, but the question I have for you is, from your perspective, is there value in the enterprise risk management versus having individual experts manage risk? For example, the individual experts may be a chief credit officer managing credit risk, CFO, financial risk, technology officer, technology, versus an enterprise risk management committee per se that oversees and provides guidance for the integrated look at risk management. Any ideas on that? Any perspective?
Yeah, I think there's perspective, and I think that one of the first things I'd highlight is that um, supervision letter, so SR letter 16-11, which is the supervisory guidance for assessing risk management at financial institutions less than 100 billion, is the
Hmm.
guidance that the Federal Reserve that we have specific to how, which is I know is the main focus of this conversation, is largely those banks that are less than 100 billion, so the community banks and
Yeah.
the regional banks, right? And so it's important that we highlight that we at the Fed, we don't have an expectation that those financial institutions have to have, like, in quotes, like an enterprise-wide risk management formal program, right? So, there's clear expectations there that, they of course have to be managing their risks appropriately, and they have to be monitoring all their material risk, right? And that's across the
Mhm.
spectrum. That's credit, market, liquidity, operational risk, compliance risk, legal risk. So there's an
Yep.
expectation that they have to manage that. And when we look at that, right, there's a subsection of things that feed into that. There's internal controls, there's
Mhm.
risk monitoring, MIS, policies, procedures, limits, and then it gets down to board and senior management oversight, right? So naturally, that leads to things funneling up through sort of one channel, right? So now, if you have a scattered approach, as you mentioned, where it's not integrated and you've got independent risk management across the organization, at the end of the day, that's got to come together somehow, right? Because
Okay.
if you're not looking at risks holistically across the organization, that is can potentially be missing um, some big items, because the risks at an organization, they can't really be viewed in isolation, right? Credit risk is going to impact liquidity, right?
Yep.
Liquidity is going to impact market risk. So there's the risks interact with each other, and um, certainly when we're looking at risk management, at the end of the day, they've got to kind of feed up through that point and through the board. And if you're not looking at those collectively, you're going to be missing out on how those risks interact with each other and what the impact of one may have on the other. So I think it is important, but not to say that we expect our community banks to have an ERM framework and that sort of thing that you would expect at a larger, more complex institution. Our approach is kind of going to be tailored to the size and complexity of the bank. But at the end of the day, bringing together all those risks to the board and to the senior management is going to be critical. So to make sure that they can respond adequately to the risks that are presented to them.
Excellent
Kevin,
advice.
can I ask you something? Is there like a size or a threshold where you would say banks should start thinking about this integrated framework in terms
Yeah,
of
so I
assessment?
mean, there's no cutoff in terms of size. Like I think obviously when you're talking about over 100 billion, I think it's very clear, right? But I think as our approach is that banks that are growing in size, they can't be thinking of, oh, I'm 100 or 101 billion, right? That there always has to be like a transitory phase, right? So as and I would also say that no bank is different, right? You could have uh, a smaller community bank, or let's say a mid-sized community bank that's engaging in a lot of off-balance sheet items. It could be engaging in banking as a service items. It could be sweeping deposits off balance sheet. So even though its asset size may say, oh, it's not that big, it could be actually larger in size than its assets indicate, just given the level of transactions that it may be processing or the types of customers. So my view is that when looking at risk management and enterprise risk management, my focus is less on, well, how big is the bank? What's your total asset size? What's your business model? What's your risk profile? How fast are you growing? To be, thinking about what is next, what is ahead? How can you be consistently looking to improve your risk management and adapt to where the institution is going? Less than, okay, you're 100 billion and this is a switch that we flick, because those institutions that are managed in that way can often run into issues when they do cross those regulatory thresholds, right? They're not prepared for the next set of standards that come, right? So it can't be a light switch. Those financial institutions have to be thinking about how do they transition, how do they prepare for higher expectations, and that should come along a way. And going back to our earlier conversation on culture and things like that, it's how is an organization thinking about that to put them in the best position for that future growth and to be tailored specific to their business activities and their risk profile.
That's great. It sounds like, and I'll put words in your mouth here. It sounds like substance over form. Form obviously is nice, but the substance is what we should all be focused on, is really having a good risk management culture and process that allows us to manage the collaborative or the integrated risk perspectives.
Yeah.
Excellent. We have time for one more question, Kevin, and then we'll let you go do some real work. Uh, we'll get down a little bit into the little bit of granular now, if you don't mind. Talk since COVID and prior to COVID, there was a growth in third-party service providers. The pandemic kind of accelerated that a lot, and during that time frame when people were not working in the office and they were home, they created some businesses, and they're now offering services. There's a lot of risk with third party. I think we all know what those are. Have you in your experiences, have you concluded on 3 or 4 top risk associated with third party service providers that should be at or near the top of our list? Or are those just more of a basic business as usual risk now, and that's how we should look at that?
No, I think there's some different implications that and different things that pop in my mind. But I think before I get into that, just gonna make one plug here, right? So in the last few weeks, the industry may be aware that across all 3 agencies, we just published SR 23-4, which is the new interagency guidance on third-party risk management.
Excellent.
This builds off of some guidance that was issued in 2013, but it expanded a little bit in scope to make sure that it's clear that it's covering how banks engage with third-party fintech providers. The guidance is principle-based. It should be tailored to the complexity of an institution, the complexity of its third-party relationships, and just the nature of those relationships, right? But it's really focused on a variety of factors. So it's in terms of vendor relationships and third-party relationships, across the planning phase, the due diligence, how is a firm looking to select third parties? How are they negotiating contracts? On a, after they've negotiated a contract and they've onboarded that vendor, how are they monitoring that vendor over a period of time? And in worst case, how do they have a termination process to separate from that vendor if needs arrive? So there's certainly is a lot of guidance out there that's been published in terms of our expectations for how banks should look at managing these third-party risks. There's also been a lot of work to make sure that community banks have resources necessary when performing a lot of these tasks, because we know that performing due diligence on these third parties can be quite a big lift, and there's the guidance also talks about the adequacy, the ability for community banks to collaborate on certain things, right? You can never delegate your responsibility. So you will have ultimately responsibility, but there is in the guidance talks about how community banks can collaborate. And then in addition to that, in 2021, we published, the agencies published the FinTech due diligence guide for community banks, which really highlights a lot of the key things that should go into doing due diligence and gets into a lot of the factors related to the question about what risks should be top of mind, right? But the next item I want to go before I directly address that question is I think it's very important that also when we're thinking about those third-party relationships, the risks that may be top of mind may be different depending on what type of vendor it is. Is it a customer-facing vendor? Is it a vendor that has access to consumer information or personally identifiable information? Is it a vendor that's used for internal processes versus delivering products and services to consumers, right? So those all come to the top of my mind. But just at a bottom line, if I had to rate a few items, right? So the operational resilience and information security of those vendors, right? Obviously, cybersecurity is top of mind for the industry now.
Yep.
I would say in the last couple of weeks, there's been a couple high-profile incidents that further raise awareness to the topic, especially for consumer-facing. For vendors that are creating consumer-facing platforms or capabilities, is that that regulatory and compliance aspect, right? So the potential for consumer harm related to those really should be a big part. And then, we're in an interesting environment right now. Community banks have, I would say, certainly engaged more with vendors. A lot of these vendors could be younger firms, younger tech companies that have relied on venture capital financing or have relied on other sort of debt financing, and we know that cost of servicing debt has increased. Venture capital funding has been more difficult. So what is the financial capacity of these third parties vendors, and what is their ability to continue to deliver those products and services for you? And then I know I'm going, I think, more than 2 or 3 items here, but I want to go back to the original, I think it was our first question, right? Is cultural alignment. So not only is it important that you have cultural alignment within that organization, from the top down to those people that are your business development leaders, but that when you're thinking about vendor selection, that there's a cultural alignment even moving into those vendors. If you're using vendors to reach customers and interact with customers and face customers, if those vendors have a different risk appetite, different approach for you, then that misalignment can also cause issues for that organization strategically, from a risk perspective and other items. So it's also important that when an institution is looking to select that vendor, they're thinking really about their strategy. How does this align with our strategy? Does this vendor have a similar culture to us? Do they have the necessary staff with the expertise to deliver on what they're saying they could deliver in a way that aligns with our expectations?
Excellent, excellent. There's one thing that popped in my mind real quick since we have a minute or two. When I was at GE Capital, we had some companies in our family that were not financial services. And I found that the interagency guidelines actually flavored my conversations with them as well, even though they were not financial services. We have some clients that are going to listen to this, or some customers who will listen to this, and they are not financial institutions. Would you mind sharing with us what is interagency guidance and how that works? And is that reasonable to share that guidance with outside of the financial realm?
Yeah, I mean, so the interagency guidance that I'm referring to is generally going to be guidance that is prepared collectively. Most commonly, sometimes there's agencies that may not join a guidance, so the guidance will specifically highlight which agencies are participating in the guidance. But
Mhm.
for example, the interagency guidance I just mentioned on managing third-party risk, that guidance is kind of co-authored by the Federal Reserve Board of Governors, the Federal Deposit Insurance Incorporation, and the Office of Currency and Comptroller, which are the three primary federal banking regulators across the industry. The guidance is publicly available.
Yep.
Anybody can go out there and access it. And the guidance is not binding like what you would expect from a law passed through Congress that has been through the necessarily confirmation process that way. Guidance really is going to cover a specific topic. So in this case, the one I just mentioned, third-party risk management,
Mhm.
and it outlines our expectations for practices that we would expect to see in certain situations. And a lot of times the guidance is principle based. So it's not going to be specific in every case about what you should be doing, how you should be doing that. It'll often cover that, really our expectations are principle based. Most commonly, our expectations are going to be tailored to the size, complexity, and risk profile of an institution. And the guidance really is a tool for banks to leverage to see sort of what practices they should be following, especially as it relates to their type of activity. Now, whether other industries can glean value from that, there might be value there. So I would certainly, all these documents are publicly available. And to the extent that another company, another industry is working with a lot of vendors and third-party risk management, there's no reason they can't just go out and pull it. But again, it's the guidance is written for our financial institutions, the institutions that we regulate, and that's how it's prepared across the agencies.
Thank you very much. That's a great explanation, and I would encourage anybody in our audience that wants guidance. I got a lot of guidance from interagency guidelines when I was a chief audit executive. It really educated me very well. So I appreciate it. Kevin, thank you so much for joining us today. Some very good insights, some great commentary. We really appreciate it.
Thank you, Dan and Juan. Thanks for having me.
Thank you very much, Kevin.